Okay, let's answer some questions from the Sunday's market outlook. And if you hear some noise in the background, it's because I have work still going on in the house. I'm changing my bathrooms, and one is completely done. They're starting on the other one now. Also, you may hear a knock at the door at some point, and I'll just pause the video. I am donating all of the previous parts of the house that are being replaced to Habitat for Humanity, because they're all still in good shape. So hopefully I can get through this without all that. One more point on the Tesla comments that I have received. I got to tell you, I'm pretty impressed. No one resorted to calling me names or being rude. They were all pushed. Some of them were pushing back against some of the things that I said. Some of them were, gave me cause to go and do some extra reading on my own to figure out, okay, well, maybe I had a blind spot, maybe I didn't see something. So I gotta say, I am impressed at the tone of the conversation. I have no problem with somebody disagreeing with me. I do have a problem with somebody just calling me names. Who needs that? But they were good comments. So I'll get to one of the Tesla comments, and I'll answer as much as I can, and then we'll just skip all the other Tesla comments because they're almost repeating the same things and the same objections. All right, for interest rate leg, for the interest rate lag, wouldn't it be important to include swaps held by banks and other financial institutions and not just corporate issuers? Banks are financial intermediaries, so they control the supply of credit in the economy. And typically they feel interest rates almost right away. They can set up their balance sheet in such a way that they can immunize themselves from much of it, but the transmission to the economy is fairly quick in raising their credit standards. Not only that, there's always some imbalance with banks at the end of the day between their assets and their liabilities, because they have to balance, right? All your assets have to balance with your liabilities. Well, a big part of liabilities is deposits. Well, deposits come in and deposits leave. So there's always either an excess or a shortage of deposits, which means they have to engage in the wholesale market. So their incremental cost is whatever the floating rate happens to be. So they transmit that to higher borrowing rates almost immediately. When we talk about the sensitivity of the economy to changes in rates, there is the existing economy in place. How badly do rising rates hurt the existing economy? And then there is the marginal borrower, or the marginal person, the person coming into the market when the rates are higher as opposed to having already been there. So it's meant to, higher interest rates will hit 100% of the marginal borrower. So if interest rates go up and I go to the bank to borrow, I have no choice but to borrow at the higher rate. I have no immunity from that. But if I had an existing loan in place and it was fixed rate and rates went up, I don't feel anything, right? So the bank itself will feel the floating rate almost instantly, because it is in the wholesale market for lending and borrowing, so that its assets and liabilities are always in balance, and it's usually the deposits that are the most variable. So if deposits are leaving for money market funds, you've got to get wholesale funds in here somewhere, and so banks are having to pay whatever that rate is. Let's see. I usually like to enter positions by selling out of the money puts on stocks I'd like to own, so I get paid while I wait to buy at a cheaper price. However, at the moment, volatility are at historical lows, so I struggle to convince myself to sell puts for such low compensation. You're not alone. I look at, before I sell puts, I look at the implied volatility and I think, well, what is the point? They are so low, I may as well sell more aggressive puts. So I'll go to 0.5 or 0.6, and if the market is moving up and I still want to sell puts, I will rather than buy the underlying, if I want to get a better price than where it is, I will sell an in-the-money put. So if something is at $38, I can look at the 37.50s if it has 37.50s. If I don't like the premiums, I can go to the 40s and I'll sell the 40s. So I know I'm going to get the $2 of intrinsic value here plus some time value. And if the stock rises to 40, well, it's the same as me buying it at 38. If it rises past 40, well, then I could have done better by buying it. But I just start to get, as volatility drops and the market starts to seem like it's trending in one direction, you move the delta of your puts from 0.3 to 0.4 to 0.5 to 0.6, and you say, well, if I don't mind owning the underlying anyways, and I can sell a $40 put, and if it's put to me, I'm getting it at $37.45, let's say, I still do better than buying it at the market. I'm still participating in some of the upside on the underlying as well. As of late, all I do is roll T-bills collecting 5% while I wait for volatility to come back online. How do you adjust your strategy in times of ultra low premiums? Well, that's what I do there. Do you perhaps simply switch from selling puts to buying calls on the cheap? Calls are only going to be cheap really at the level of the index because the level of the index still maintains volatility skew. So skew is if you're looking at IV and you're looking at all the different strike prices. Here's an at-the-money strike. These are puts over here. These are calls. Skew at the index level tends to look like this. But at the stock level, you tend to get a smile on IV if this is at the money. So when you're buying calls, they do have higher and higher implied volatility as opposed to lower and lower implied volatility. So you're not getting much of a deal at the individual stock level, but that's really where you want to buy your calls, at the individual stock level. You'll probably get your best IV either at the money or slightly out of the money in terms of implied volatility. If you're thinking about that in terms of the cheapness or expensiveness of the call. The further out of the money you go, yes, they are cheaper, but you are paying more of that in terms of the volatility. So remember, theta is your enemy when you're long calls, which means the higher the implied volatility, the time value is what you're going to lose. So even though it's cheap, you'll tend to lose it faster. That's all. So you might want to try to find some at-the-money calls and go with that. But at the individual stock level, it's not always true. Remember, the IV that you see is an at-the-money IV. As soon as you start going out of the money on calls, implied volatility is higher. And same with puts. Once you start going out of the money on puts, the IV is higher. So you can find high IV premiums, but the premiums will be very low because they're so far out of the money, but most of it will be for volatility. Let's see, 2 questions. On top of elevated cash balances at corporations, could high yield OAS also be tighter than expected due to higher percentage of secured collateral? High yield typically is secured. Investment grade is typically unsecured, and high yield is typically secured. So it does have a higher percentage of secured collateral on new issues than investment grade would, because it typically is secured debt to begin with. Typically secured. What are some useful resources for learning how to trade metal commodities like copper, steel, aluminum? The best place is to look for the industry organization for each of these. There is a copper industry organization, a steel industry organization, aluminum industry organization. Learn as much about the production process, the smelting process, the inventory process as you can. And most of these industry organizations will also have a lot of good detail about inventory levels. They'll also include a lot of good research in terms of forecasts, what the industry associations' forecasts are for production. Production from South America, production from Australia, production from North America, wherever that particular mineral or metal is produced. And also sources of demand, projections for demand, projections for the tightness of the market. So you can get a lot of data, a lot of information about copper, steel, and aluminum, and gold, and silver, and almost any metal from the industry organizations. Also, have a look at the U.S. Geological Survey site. There's a lot of data there, especially for U.S.-centric mining. Well, I shouldn't say especially, primarily for U.S.-centric mining. As far as how to trade them, well, then that's not a question of knowing a lot about copper. That's more about knowing a lot about securities. You can use futures. You can use ETFs that track the commodity itself. You can use each ETFs that track the producers of the commodity, or you could just buy the best in class in each section in terms of commodity producers, because now you have a dividend stream, whereas if you buy the futures, you're more than likely going to have negative carry if the futures are in contango. If you can find a futures in backwardation, that means you found a tight spot market. And if you're long at lower and lower prices. So if the spot market drops and you were long over here, you can actually still make money because of the negative carry. So for this kind of stuff, for backwardation or contango, this really has nothing to do with knowing how copper or the fundamentals of the copper industry. This is about trading itself. If you have the Applied series, when I start the portfolio construction and management seminar, which starts July 17th, one of the things that we're going to look at is, let's say we decide we want exposure to copper. Well, what are all the ways we can get exposure to copper? What are the advantages and disadvantages of all the ways that we can get that we can get exposure to copper? And it's not as simple as you think. For copper itself, I could probably come up with half a dozen ways to get exposure to copper, all with different advantages and disadvantages off the top. You don't just have to buy a copper futures contract or buy a copper miner. There are a whole bunch of things that you have to think about. If you're going to buy a producer, what producer are you going to buy? What country are they happen to be in? Sometimes you can get great exposure to copper by simply buying a futures contract that tracks the Chilean index, not copper itself. You can get, because the producers might get an extra boost up and above the price of copper. There's a whole bunch of ways, right? So go to the industry associations, learn about the commodity itself, and then learn about the different ways to get exposure to the commodity, which is more about learning about the securities themselves. That's a long answer to your question, I think. In your opinion, what's the best trade to make to bet that OAS spreads will increase? You can be short a high yield ETF, HYG. I think is the high yield index. But if you're short this, it's expensive, right? You're going to have a borrowing cost to get that done. And since it has a yield, you're going to have to pay the yield to get that done. So what you can do is create a synthetic short using the options, and then you're not going to have that cash outflow component, and you don't have to worry about a borrow cost if you use a synthetic short. See, you can get it this way, you can get it this way. There's probably other ways that you can get it done as well. Shorting a corporate bond is not an answer. CDSs, you can, if you're institutional, you can go into the CDS market. If you're retail, because CDS is over the counter, OTC, that has counterparty risk, you probably do not qualify as a qualified counterparty for any dealer. They would probably look at you and say, well, I'm not taking the risk of you. Never heard of you. Let's see. I looked at CME products and it seems there's no futures product tracking corporate bond prices. Because bonds, especially corporate bonds, are traded OTC. Let me get a better pen here. Traded OTC. Most derivatives are OTC as well, which means you need a dealer. You don't necessarily, or not. It would be difficult, I think, and hard to have an exchange traded product on such an illiquid underlying, and an underlying that really is an OTC market to begin with. Otherwise, I would just go long ZB. ZB is a bond, a treasury bond. The long bond, treasury bond, has no credit spread. That's not going to help you going long ZB. Well, actually, let me take that back. If you are betting that spreads are increasing, if spreads are increasing, there must be stress in the economy. And if there's stress in the economy, money does run into bonds. So the yield on bonds would drop. So ZB would increase. But if you are betting on corporate spreads widening just because they should widen to reflect higher, and right now we're seeing, if you look at default rates in high yield looks starting to look like this, but leveraged loans are looking like this. And that is considered a canary in the coal mine for high yield bonds. that if you are considering that the economy won't hurt, it's just high interest rates will cause higher defaults and higher spreads without an interest rate effect, then ZB won't help you there. I prefer not to short an ETF like HYG due to negative carry, and then consider the synthetic short on HYG. Looking at treasury issuance being mostly in bills shorter than 6 months duration, what does it say about fiscal policy spending over the short term? Well, it could be a number of things, and I think the biggest thing here is in the reverse repo. You have greater than $2 trillion, and they're there because they need very, very, very short-dated money market securities with no duration. So if you can fill in the gap in the marketplace with a whole bunch of T-bills, 30, 60, 90, 120, week later 30, 60, 90, 120, week later 30, 60, 90, 120, over time you will have a whole bunch of 2, 3, 4, 5, 6, 7 day to expiration T-bills that you can then suck money out of the reverse repo, because that is just costing money to have that. That is costing the Federal Reserve money to have that in place. Why not shift that cost over to the Treasury? Yeah, you're going to have a whole bunch of T-bill issuance so that you can fill the gap for money market securities so that you don't have to rely so heavily on the reverse repo. The other thing is, if you look at the forward curve for 3-month rates, it is downward sloping, so that the belief is that the path of the 3-month rate is downwards. And if the path of the 3-month rate is downwards, you will go from a yield curve that looks like this to a yield curve that is upward sloping. If this is your 10-year, you can then start issuing 10 years at lower rates if you wait maybe a year. And you can why lock in a 10-year at this rate if in a year 10 years is going to be at a lower rate? So it might be worth having higher short-term interest costs until you can lock in longer-term lower interest costs. How does fiscal policy in 2022 compare to historic levels? And what impact would an accommodative fiscal policy... Accommodative? Well, first of all, we've had nothing but accommodative fiscal policy in the U.S. now for, 40 years? It's been actually, since Clinton. Clinton ran fiscal surpluses and actually paid down debt. After that, it's been nothing but fiscal deficits, which is accommodative. What impact would accommodative fiscal policy have on an economy where monetary policy is tightening? Right now, I don't think very much. Only because it has been accommodative for so long that if it continues to be accommodative, nothing has changed. The only thing that could change is if it becomes restrictive. And, you had a shot. McCarthy and the Republicans had a shot at that, and I think they kind of blew it. They claim to have the biggest spending reduction in any Congress, and it's like, well, no, it's not true. It's just, if you think about it, what it could have been versus what it is now over the next 10 years, you can make that subjective assessment that this is the biggest, because without us stepping in, it would have been ridiculous. So yeah, let's claim that we had the biggest, but not really. It's still deficits as far as the eye can see. As far as the eye can see is deficits. And with a aging population and a lower growth environment going forward for trend growth, that is unsustainable. That is two cars racing at each other. Unless one swerves, there's going to be a bad accident. So I don't know how long that can go on before the market reacts to it, but right now the market doesn't care. The market doesn't seem to care. Can you figure out how much corporate debt has been refinanced at lower rates? I'm sure you can, but that's not. I don't know that you'd get that publicly. That would require a lot of legwork, which means that it's going to be behind a paywall somewhere. It's going to be part of a subscription somewhere. Bloomberg probably has good data on that, because on the bond side, Bloomberg is if you're looking for data on bonds, Bloomberg's got it. If you're looking for economic data or equities, they're just an aggregator. I mean, you can get all that stuff yourself, but some stuff you cannot get without actually paying for it. So for something like that, you could probably find it. That information exists, but it's aggregated by somebody else and presented to you, so you don't have to do the legwork. I don't know where I would find that. In the context of an analyst job at a pension fund that mostly selects and tracks external fund managers depending on allocations, do you think this is a good environment to develop my skill in 2023? Well, at the sponsor level, you're responsible for the strategic asset allocation, which is a very top-down approach to things, because you have to determine how much in equities, how much in fixed income, how much in alternatives, and within equities, how much in small cap, how much in large cap, what factor exposures do I want, because you have to send them all to different managers, and then you have to assess the managers. So yeah, I do think it's a good environment to develop your skills. But when you say to develop my skills, which skills specifically? So if you're talking about a good solid foundation in macroeconomics and top-down forecasting, yeah, I think so. If you're talking about developing a skill in manager selection and evaluation, yeah, I think so. Will it open up further opportunities for a career in asset portfolio management? The top-down aspect, yeah. At the level of the SAA, yeah. For bottom-up stock pickers, that's not what you guys are doing. If you're an analyst at a pension fund looking at other external managers, you're not asset picking, right? So, reviews regarding the Canadian housing market. As OFC and banks have become more lenient on trigger rates, we are seeing negative amortization and interest-only mortgage payments for existing fixed payment variable holders. Do you believe the continuous rate hike path is rational when homeowners are able to defer the impact of those hikes? Well, here's the thing, a lot of the economy is immune from interest rate hikes. You're trying to make the marginal buyer you're trying to back off the marginal buyer because you are trying to reduce aggregate demand. So if 10 people own a home, 10 people own a home. You're not trying to put them out of their home. You're just trying to make sure the 11th person doesn't get a home, because it'll push up home prices for the 12th person. And if the 12th person gets a home, it'll push up prices for the 13th person. So if you can stop it at the 11th person, then you can make housing more affordable over time. And that, I'm just using housing as one example. If you do that, you'll actually slow down employment, which will bring slack into the labor market. Then wage gains don't have to be so high because you can find employees anywhere. So the central bank does have a mandate for price stability. It does not have a mandate for affordable homes. That's not its mandate. It does not have a mandate to increase home ownership. That's a fiscal thing. That's not a monetary thing. That's a fiscal thing. But all too often today, the fiscal side is abdicating its responsibility and putting more and more pressure on the central bank to do it all. But the central bank has one tool: interest rates. That's it. And it's a blunt tool, and it works on demand. That's the best they can do. So the housing affordability issue in Canada is a fiscal problem that requires a fiscal solution. It's not the central bank. Now, the central bank can't make it better. They can, depending on what side of the housing market you're standing on, they're either making it better or making it worse. But if you want affordability, that is a fiscal side. That's policy. And the best policy path right now is deregulation. Is minimize the time from the time I buy an unserviced lot to the time I can build on it. Get rid of all of those bloody permits I need along the way, all of the surveys and all of the reviews, and get rid of all of that. Instead of taking a year and a half, it should take me 4 months to get everything done. Now that lowers my financing costs, because I only have to finance that unserviced land for 4 months, not a year and a half. And then you will increase the supply of homes, which will drive down the price because it costs cheaper to hold and finance the build out than it otherwise would. Central banks aren't going to help with that. Let's see. How long are the Applied series portfolio construction videos going to be? Each one anywhere from half an hour to an hour, depending on what I want to get done, and one a week. If you aren't sure yet, that is fine. Yeah, just it won't be long. What main takeaways do you believe retail investors can take away from CFA? Well, at level one, a good understanding of everything, a good understanding of how of what equities are, fixed income, derivatives, alternative investments, a good understanding of how businesses make decisions because you have corporate issuers in there, a good understanding of the basics of economics that I think that are important when you go to level two, the basics of valuation. How do you value an equity? How do you value a fixed income security? And level two really focuses on bonds with embedded options. You'll learn how to value just normal plain bonds at level one. So it gives you a lot of valuation. Level three gives you some portfolio management techniques, but at an institutional perspective, not so much for the retail investor. Will it make you a more aware retail investor? Yes, it will. But I think that the three levels, while they introduce risk at all three levels, I think don't pay enough attention to risk. I think that investing is a risk management process. It is first and foremost a risk management process, not a return-seeking process. And retail investors, invest in a return-seeking way. I'm going to buy this because it's going up, buy that because it's going up, buy this because it's going up. And they may end up buying three things that are so highly correlated they don't recognize how much risk they've taken on. So I think that if you put risk first and return second, return will take care of itself. But I think that CFAI, the three levels, gives you a very good grounding in a whole bunch of stuff and opens doors because you don't know. I mean, you may start down this road and you don't know. You may land a job at an investment bank or a hedge fund somewhere and you say, well, this is great. This is where I wanted to head to. I mean, you don't know what doors lie at the end of a road until you actually start going down that road. And you don't know what roads branch off from that road until you start going down it. So sure, I think there is nothing wrong. Currently studying for level one and have realized that I now gain a much better understanding of the many types of risk that exist. Look at that. However, I would love to hear your opinion on takeaways. Well, you're already on the path and you're already recognizing it. Given that some Canadian banks are offering 40 rate mortgages instead of 25, is that true? I mean, we used to have a 30-year amortization way back, and that was, I'm not going to say outlawed, but it was eliminated, and the max was supposed to be 25. I've not heard of a 40, but then again, I'm not in the market for mortgages. I haven't been for a long time, so I would be unaware of that. How much relief could this provide for customers in the face of potential rate hikes? Well, most retail consumers don't manage the interest rate, they manage the price. They don't manage the price or the interest rate, they manage their monthly payments. So when they go to buy a car, they don't look at the price of the car or what interest rate they're paying on the car. They look at what their monthly payment is going to be. Okay, that monthly payment's too high. What about that car? That's $420 a month. Okay, that's good. Didn't matter what the price of the car was or what the cost of financing was. It's the monthly payment that's important. Same with their mortgage. They manage the monthly payment. So if buying a car and going from a 5-year to a 7-year loan gets that monthly payment in the target range that you needed, that's what you'll do. It's not as if you look at it and say, I'm not paying 9% interest. You give it to me at 7.5% and I'll take it. They don't do that. It's I need the monthly payment to be this much or fall within this. So if there's a longer amortization period, it makes the consumer more immune from interest rate hikes at that point. Canada's a little different though, because you don't have 25-year locked-in mortgages. You usually have 5-year fixed rate mortgages, and you got to go back in 5 years and renew your mortgage. So because every year mortgages come due and you got to renegotiate. Whereas in the US, they don't have that. UK does, Canada does. So the Canadian homeowner, on average, is far more sensitive to interest rates than the US homeowner is. So because every year, 20% of all those 5-year fixed rate mortgages, on average, really, if you think about it in a laddered sense, 20% every year have to go back to the bank and sing for their supper. So if they do have the potential when they go back, if they're 5 years into a 25-year, rather than saying, okay, well, your next mortgage will be 25 years of a 20-year, they may be able to say, no, can we re-extend it to 20? Because they're renegotiating their mortgage, right? They can renegotiate. If there is a 40, maybe they'll go to 40. I don't know if there is a 40 for sure. But if you say there is, I'm going to take your word for it because I'm not in that mortgage market at all. I wouldn't know. Good point about the amount of debt that has hedged interest rates. Since risk cannot be destroyed, only transformed, do you think the financial system is allocating this risk more efficiently? They hedge it all out. So they'll take on the risk that you want to get rid of, and then they will use the underlying to hedge it out so that they will then have a portfolio of an asset and a liability. Whereas you just have the derivative contract, they will take the derivative and trade in the underlying to hedge it out. So in the end, it is some underlying somewhere is from some issuer, whether it be a government bond or a corporate bond, but they'll use either the underlying or other derivatives to hedge it out. Not only that, they don't have to hedge out everything, right? So let's say you have swaps, that you have a bunch of parties to swaps, 1, 2, 3, 4, and you have the dealer on this side. And the dealer for this swap here is on the pay floating side. Maybe on the pay fixed side over here. Maybe on the receive floating side over here. Well, if you're on the pay fixed, that is the receive floating. Sorry, let's just do it that way. That's receive floating over here, and maybe on the pay floating over here with different notionals. So, 10 million, 20 million, 5 million, 15 million. So a lot of these pay floating, receive floating things will cancel out, and there'll be a small net position of which they'll hedge away. Since they're a dealer, they can be on the side of, since they're on the other side of every other counterparty, some of these cancel out. So that by their very nature, they're hedged just by being the dealer. Unless they're all one-sided, then they would either increase their bid-ask spread so that the amount that they make on each swap offers some protection, and then they would hedge out as much as they can with interest rate options or futures or with the actual underlying itself. Let's see. Currently taking the Applied series. Very excited for August. It's now July. I have only a little over a year now in the market, coming from construction, culinary background. What would be some good starter tools to learn the vocabulary and basics of the market? If you go to markmeldrum.com and register for free, the entire 2018 Level 1 CFA is there. If you can get through get through the asset classes, equity, fixed income, derivatives, alternative investments, yeah, you'll be up to speed. You'll have the language that you need there. And maybe run through economics as well. I have a quarter position, and I'm using the allocation factor to get a full position with 0.3, 0.5 delta puts, failing to get assigned. Doesn't that suck? Eh? Failing to get assigned, the market just keeps running in the builders. So you got to move up. You got to move up your delta on those. And I just saw this morning Credit Suisse raise their target price on almost all the builders, all the U.S. builders. At this point, after a big run in 2023, no kidding, a big run. They did have a slight pullback. I think it was like 4 or 5% a couple of weeks ago, and then just ran from there again. I've never seen a market so unidirectional in the face of, like, I've seen this kind of thing before when central banks are lowering interest rates, when credit availability is increasing, when the yield curve is steepening instead of being inverted. But I've never seen this type of exuberance in the face of rising rates, of draining of liquidity, of decreasing of money supply, of credit, a shrinking credit availability. I've just never seen this kind of exuberance, and not just exuberance, but it's every day. it's not like, okay, we're doing this slow grind up. We're not. We're going parabolic. It seems that the buying is increasing with increasing speed. As it's going up, we're going parabolic. And if you look at the 200-day moving average and you look at standard deviations, you're more than 2 standard deviations above. That's usually unsustainable, but, try to tell the market that. And it's just very, very odd. So when it starts to do this kind of thing, you have to, if you still want to be in the game, you got to increase your deltas on your puts. But if you do get assigned, you are now getting assigned at very high prices. So you have to believe that prices can go even higher from where you get them. Would you sell deeper in the money puts to get the stocks, or stick with 0.3 and 0.5? I've gone to 0.6 on some things, just because I think there's upward price momentum here. I'm going to buy my position now. Let me go to 0.6, right? A couple of points with Tesla. Totally agree with charging station contradiction. Okay, Mercedes beat Tesla with respect to level 4. This was only improved for certain parking lot and airport. And it's the same thing with Hyundai. It still doesn't change the fact that it is level 4. Hyundai is in a particular region in South Korea. In just that particular region. I feel that the reason Tesla can compete with the giants is because this genre of car relies almost exclusively on technology, which is still unmatched by competitors. I don't know if I would say it's unmatched by competitors. I think if we say it's unmatched by any one single competitor, you may be true, but it is not unmatched by competitors on almost every dimension. You can find another competitor that is superior. Now that other, when you find somebody that is superior, it is not concentrated in one car maker. That's the thing. It's concentrated. It is spread out across all this car maker or this car company is better at this thing than Tesla is, and this one's better at Tesla on this dimension. So it is not the leader. Tesla is not the leader in any one category of technology, but as a portfolio of technologies, if you want to say it has got a lead as a portfolio on any one single car company, I'm not going to disagree. Let's see. So Tesla is number 1 EV in EU. Stellantis sells more EVs in the European market as a car company than Tesla does. You may be taking a particular model, maybe the best-selling model, but you have 2 models. Stellantis has many, so that collectively Stellantis sells more EVs. Stellantis has more EVs in Europe, and Tesla is number 4, I think, in China. BYD, I think, is number 1, and you're not going to like this, GM is number 2. GM's partnership in China is number 2. It's either number 2 or number 3, but GM with its partner in China sells more EVs in China than Tesla does. What do you think about the production infrastructure that they built up with their gigafactories? They can produce thousands of cars per day. It is true that their margins are shrinking, but in absolute terms, they're producing gigantic numbers. Well, not really. I don't know if we share the same definition of the word gigantic. So I would have to take a Socratic approach to that and say gigantic. Well, what do you mean gigantic? What does gigantic mean to you? The 50% growth, that's gone. 40% growth, that's gone. They seem to be approaching 30%, which is still pretty good. But when you're at a low base, it's, I don't know that if they were at 6 million, they'd be at 30%. That would be hard to do. But I think that will moderate to 20%, then 15%, then 10% as the years go by. Their margins were 30% just a year ago. They're 20%. I don't think they get to keep those margins either. I think in a couple of years, those will start to head down towards 15%. Other EV makers' margins will start to head up, and everyone will concentrate in and around a tight range. That is not a knock against anybody. That is just the history of industries. especially big asset-intensive industries like automobiles, where the operating margins will tend to cluster around a very certain at a certain point. So it is the inevitability and the gravity of economics that are going to bring those margins down. Tesla doesn't advertise, but they're going to have to start to. And even Elon Musk about a month ago says they're going to start considering advertising. And I said this in a video last year that you have to take 5 or 6 points off this 30-point margin for eventual advertising. You're going to have to, and the more crowded it becomes, the more choice consumers have, you're going to have to rely more on just the personality of one person. Even Apple knew that. It wasn't enough to rely on Steve Jobs. They advertised heavily. So I think that you have that in their future as well. I don't know in the U.S., but Europe, charging is not a commodity, I think. The trip planning tool in the car is a real added value. Well, EU, I think, is CCS. Was it CCS 2? The trip planning tool in the car is a real value added, and for drivers, and supports only the Tesla network for time being. On long trips, I have to plan ahead to get best rates with flat monthly subscription. And if I want to do things the easy way, just tell the navigator where I want to go, and it will take the car nice and smoothly. I guess a lot will depend on how this will be implemented. Tesla will be able to offer the same experience, and I agree with you. Well, I can't speak to the U.S. I know that the NACS standard that GM and Ford are siding with Tesla is called a North American charging standard, as opposed to the CCS, which the White House is sort of pushing and the industry association is pushing. But I guess it's clunkier to use. It's not as, I don't have an EV, so I can't speak from actual experience, just from secondhand information based on what you read. But being that it is a North American charging system, there is some question as to, well, it is not the biggest automobile market in the world. So it might have limited benefit because GM and Ford, if they're selling cars in other markets, are still going to have to make vehicles with other that can handle other charging systems. So, as one person said, it's in the name, North American charging system. I think in time, the idea that that the station itself catches all the information, that's if you're using it. If you charge at home, there's no information. If you charge at any other station, there's no information. What will have all of the information? What will have all the information? The car. The car will have all the information. The car will capture everything. So if you fill up at a Tesla supercharger, it'll get some information from you. But I want you to think long and hard about how you monetize that. How are you going to monetize random information? Where I'm not going to be at your charger all the time. I'm going to be at different chargers. The car will know everything about me. The car will know how I charge. You're going to have some view into me. Some view, yes. But how are you going to monetize that? You're not going to send anything to my car. If I'm GM, I'm certainly not going to allow that to happen. You have to find a way to monetize that. Now, you have the app, but I'm thinking that if there is one standard and one company controls it all, Congress is not going to allow that. They will say, okay, you have to have a card swipe on the charging station and not just the app. You cannot control that much information. So if it's the winner's curse on this one, right? If they do win and they win it all, I think regulation will step in very quickly and say, whoa, we can't have that. We simply can't have that. So it's a step in the direction for Tesla to get a view in to everybody's life, a small view, but a view still, nonetheless. You can't discount that. The car has the better view. clearly. It is a step, but it is nowhere near a done deal in that sense that it's going to guaranteed be a benefit. It is a step in the right direction, but it doesn't mean it's going to happen. So, but the market seems to be pricing in like it's going to be this wonderful thing, without on the other side saying, but hang on a second, if there's going to be all of these wonderful cars that are non-Tesla, shouldn't we bring down our growth rate and our market share for Tesla sales? That to me was the crime in the valuation that I saw, and that other analysts did, is that they did not, they got all euphoric about how many cars are going to be using this system, without saying, but wait a minute now, if there really are that many cars, then isn't that going to be competition for Tesla cars? Shouldn't we bring down our growth rates there? That's kind of where I had the big issue. And there was another comment about these chargers. These are all level 3s. Anything you find out on the highway is a level 3. It could not be a level 2. Level 2 is far too slow. Level 1, you're just plugging it in your house. It could take up to 3-4 days to charge your car. Level 2, you need an upgrade to your house to get that done, but they're anywhere between 20 and 40 miles an hour that they can recharge. Level 3, these are the fast charging stations, half an hour for a full charge. Usually that's the number they try to get in under. That if you can go from 20% to 80% in under half an hour, it's a fairly decent charge. They're all level 3 chargers. These are all tens of thousands of dollars to build out, so no house is going to have a level 3. So they're all level 3. The downside of EVs, which really isn't talked about a lot, is these ions want a slow charge. The faster you charge, the faster you or the lower your battery life, the longevity of your battery is. So the faster you charge, the less and less battery life you get. It's actually a negative. So it's these road chargers are really last resort chargers. They're more for I have no choice or it's an emergency, as opposed to gas stations, which we have no inventory of gas at our homes. We allow gas stations to keep all the inventory, but we have a lot of inventory of electricity in our homes. So whenever you get home, you plug in your car. That you're using these charging stations as these sort of last resorts. They're still being used, they're still there, but the majority of charging is done at the home for those who have a home and those who have access to it. For apartment buildings, you're seeing more and more of these coming in. Same with apartment buildings. Seeing more and more of those going in. I just think that we're so early in the system, and this standard is, it's not an adopted standard yet. It's not a done deal yet. It's not a done deal. And to price all of that in now, to me, seems really premature. And one more point on Tesla that I will get to is they're in China. And a lot of the supply for electric vehicles, the process supply, comes from China. If they want the island of Taiwan and the U.S. pulls a big battleship in the middle between the mainland and Taiwan, I don't know that the Chinese government will continue to look at Tesla and say, yeah, let that American billionaire pull money out of our country. We're good with that. I still think there's a lot of country-specific risk in that facility that just doesn't seem to be priced into the vehicle, that the higher the tensions go between U.S. and China, doesn't seem to spill over into Tesla. And if you wonder, well, why did Elon Musk go to China? Well, because he's there saying, look, I don't agree with these guys back in the U.S. You guys are the king. You guys got it. You guys want Taiwan, it's yours. I'm your friend. Don't hurt me. So I think he had to do a goodwill tour to let China know that, hey, I'm not one of these guys. But, to not reflect any fear of that, to me seems, again, just one of those, I guess it doesn't really matter. Oh, one more thing, by the way, I have to say this. Kathy Wood, the ARK Fund, has a $3 trillion price tag on Tesla. And we're all excited about this GM thing, and they're just raging about how great it's going to be. And they sold their shares at $800 million valuation, dumped a whole bunch of Tesla shares. So I got to ask, if you really believe that it was $3 trillion, why are you selling at $800 million? That's like having an $80 stock with a $300 price target and dumping your shares at $80. Why are you telling people there's a $300 price target if you're selling at 80? Again, it goes to what I think Kathy Wood was really doing, was telling Tesla shareholders exactly what they wanted to hear, but that she herself didn't believe it and said, this is there. I got what I wanted out of you guys. Screw you. I just found that interesting when I saw that. Can you please elaborate on the way you calculate the effectiveness of interest rate increase? I don't know that I can elaborate on it. I would just rewatch it with the, just being a little bit more careful. It is just a back of the envelope calculation. That's all it is. It's just back of the envelope, just quickly by looking at how much debt is outstanding, how much of it is floating rate. So that how much of the existing debt right now, what percentage of them are sensitive to the changes in rates. And then I just used a subjective rounding up to be conservative. I definitely do not disagree with your take on Tesla, as I've followed the stock for years and have been both rewarded and punished while trading it by the vast amount of retail momentum. Retail momentum for sure. I think the main argument that the Tesla fanboys, the Tesla fan investors, because hey, we live in that world now where we can't genderize a group of people, right? Would make is that the company's high valuation due to future growth. Well, it is due to future growth expectations. Hope. It is. That's what it is. It's hope, right? I saw consumer vehicles make about 85% of Tesla's revenues. And I have been through Tesla's income statement, and if you look at their other segments, one of them is a money-losing segment, and one of them is very, very low margin, and that's their charging stations. I think it was 1.8 billion in revenue, 1.7 billion in costs, very low margin. Nothing too exciting there. I do agree. Okay, so one question on interest rate swap. I understand one leg is fixed and would not be impacted by IR increases. Well, it is impacted by IR increases, right? Because it is fixed. So the swap gains value. So it is impacted by the interest rate swap. So anybody that has that swap is gaining value. The swap becomes more and more valuable. So if they closed it out, the other side would have to pay up if they want it out. So it does have some value, but if they plan to hold it to the end and they're really just trying to hedge an interest rate risk, then yeah, they're unaffected. I'm not clear who is carrying the floating rate, the dealer. And as I described earlier, the dealer can hedge out all sorts of things. Curious if you're investing into something else other than the market. Wheat. I'm doing a spread trade between cattle and beef. I am still interested in the yen. I think that by the time you get in the fall and they abandon yield curve control, you're going to have some snapback from the carry trade that's going to push the yen. Copper, I think, is a long-term play. Oil, I think, is a good 3 to 4 year play because you're going to move into very tight markets. Peak oil demand is either already here or will come in the next year or so. And then from there, demand will drop, but supply will also drop. I think supply will probably try to drop faster than demand and keep oil markets tight. Because this is it. This is it. If you want to monetize that stuff in the ground that you got to manage your supply on the way out. By that I mean, are you an angel investor or do you own a lumber yard or any other VC on your own? No, I invest. I had a CFA prep business which I sold. Now I have the Applied series, which I still own that. So I own the revenue stream associated with that, which has a lot of building out left to do to get it to where I want it to be. But I have shifted my thinking in terms of what I want to give money to. I have given a lot of money to charity. I've helped, there's a women's shelter in town. I've helped that. Big Brothers, Big Sisters. I've helped community care. I've helped hospice, we donate to. Humane Society, I've donated to. But here's the thing with these. I don't feel that I'm solving, I don't think that I'm solving anything. I think I'm filling a gap. I think I'm paying for stuff, but it's a one-time thing. And I think every time I donate, I'm paying for one-time thing. It occurs to me that I could do a lot better by finding some good entrepreneurs that have a good idea and investing in their business. And if their business grows, it creates employment, which creates a tax base, which helps a lot more than a one-time gift to each of these. There is some belief that the best way to help society is to pick up from the bottom. But I am shifting that belief and thinking, no, the best way to society is to help those at the top. Because if you can help them be bigger, they will create a better society through more employment, larger tax base, probably, hopefully some exports of goods or services that then brings wealth into the country, which then helps everyone. And now you're creating an annuity. As opposed to a single donation, you're creating an annuity, because if you take the tax base of the growing revenues, it is an annuity for the government, which is in the business of managing society. Not so much managing the economy, I wish they were, but managing society. So I have shifted towards thinking that funding entrepreneurs, instead of donating $250,000 to $500,000 a year, why don't I invest in businesses to that level, right? So I will begin that. I think this year at some point I'll start looking into that, and then you just join some angel investor groups. There's one in Toronto. I think there's a couple in Toronto. There's one in Niagara Falls. You pay a fee and you join an investor group, and it gives you access to deal flow. When I'm doing research on a stock, if I want to read about a sector, subsector, and industry in which the company operates, where do I look for the relevant information? It's a lot of Google searching. But pay attention to the validity of the sources that you're using. There are very few good published books on each particular industry or sector or subsector. If you have access to the Applied series in the sector studies, I have started doing that. I'm working right now on banks, understanding banks and how you would read the statements for banks and how banks make money, going from a very simple bank all the way up to a city center, or what I call market center banks that have investment banking and retail, just a banking book and a trading book. So you can use that, but I haven't found any one good source that has everything. It is, you have to curate across a number of sources. And sometimes as you're curating across a number of sources, you find conflicting information. And when you don't know what it is, you read this and then you read that, and they say the different things, and you're thinking, well, who's right? Because I don't know. I'm relying on them, and they're both saying two different things. So now you've got to go and curate information about those things and see, okay, well, is the preponderance of other sources landing on this side or that side? It's slow and it's tedious work. Looking for sources that are publicly available, which retail investors can access. I used to refer to IBIS World and put the numbers together using Statista, but those were during the university days. Yeah, universities have access to great libraries, but here's the deal. If you are a graduate of a university, you can get an alumni card. It's a student card. Most universities have this. And as long as you are on campus, as long as you are on campus, you can access the library database. But you have to be a student, an active student, paying tuition fees to access it off campus as you log in. So if you do have your student number still, if you have your card and your student number, I think it's just a matter of going to the library, the university library. They'll activate it for you, and you can access the university system and all the databases, all the journals, everything, if you are on campus. Because if you are on campus, you're considered just the university user. You're not another user logging into the system, right? Is there a limit to how much interest rate changes can be hedged by futures or swaps? No, you can hedge them all if you want. For example, when we think about the delay factor with rate changes, it might take 3 to 5 years for changes to permeate throughout the economy to the same degree. Yeah, you're right. When you look at a company like Agency, it has interest rate swaps in place such that it is swapping out its floating rate on repos down to a fixed rate of under 1% or 1 point something percent on the fixed rate. But these swaps will expire in the next year, 2 years, 3 years. So they will expire at some point. With the level of financial sophistication we have today, increases in interest rates do not have the same effect and I think have a much longer lag than they would have had in the 80s. So that I think monetary policy has to take that into consideration, that it works with a lag, but the lag is even longer now, and for some individuals there will be no effect on the interest rate hike at all if they're not in the debt markets. If they're not in the market for debt whatsoever and they have cash to buy things, they are absolutely immune from interest rates. For example, I benefit from interest rate increases because I have savings. And I have cash. So if I want to buy a house and interest rates go up and forces house pricing down, people like me benefit the most. We benefit the most because we have no exposure to interest rates at all. So there are, I think, more people today who have no exposure to interest rates than 80 years ago. And I think there's a lot of people today that benefit from interest rate increases more than 40 years ago. I don't know that the interest rate is as effective as a monetary policy tool as it was 40 years ago. So what do you got? The money supply, right? Okay, Adobe will definitely talk AI. No freaking kidding. It would be, I think, cause for dismissal of the CEO if they did not mention AI at least 50 times. Period. They would be foolish not to ride this wave. Probably the most useful application I've heard for AI so far is Photoshop increasing the resolution of photos. Yeah. Game changer for graphic artists who are often limited by starting resolution of an image. Yeah, I've seen their commercial where you can insert all sorts of things and you can change the picture, and AI will extend the side of a picture by just extrapolating what would have been there. Make it look like it's a continuous flow, even though maybe something else was there in reality. But they are going to talk it up. Period. They're going to talk it up. I think that if you had an auto mechanic in a neighborhood shop with 2 bays that was publicly traded, they would be saying they're using AI. You have to say you're using AI today. It would be irresponsible to the shareholder if you do not mention AI, even if it's not true. Even if there's nothing you can do with AI, you gotta find a way to stick AI in your management commentary or in your earnings call. You gotta put it in there. Like in '99, everyone said .com. Everyone was saying .com. You gotta say it. You gotta say it. When you enter a position and realize that you've made a mistake in your analysis and now wish to exit, do you believe it is best to try to balance DDB against a position and hedge it, or simply better to cut the loss? Well, it depends. It depends on what I think and what I expect going forward. I'll usually manage the loss very early. When I see it going the wrong way, I won't wait till it gets to a bad position. I'll manage it as best I can, but let's say a loss continues on at some point. Yes, at some point you have to say, you know what? That's it. I'm out. That's life. You are not going to have a perfect record. You are going to be wrong, and you are going to take losses. That's the nature of this game. It's the nature of this industry. Not a single person in this industry has a perfect record. Warren Buffett back in 2020 took a big hit on dumping all the airlines. And now all the airlines are just killing it. Had he just stayed in, he would have been okay. They're killing it. But at the time, even given all his experience, at the time, given the information that he had, his best bet was that this is not coming back for some time. Given this pandemic, people are not going to want to be in close proximity to each other in a plane. And that was his calculus at the time, and he was wrong. You're going to be wrong. You're going to be wrong. And at some point, you just have to say, no, that's it. I'm just going to take the loss. Done. Don't mean to get political. I want to get your thoughts on the following. Trudeau's government is attempting to force higher rates and for longer. The government has nothing to do with interest rates. That is a central bank. Tiff Macklem is raising rates, not Trudeau. So that eventually insolvency increases, people default on their mortgages, and housing crashes on a I smell a conspiracy theory coming on here. It's very clear the Bank of Canada is not an independent organization free of... It seems that Canada is becoming less and less capitalist country, shifting towards a more socialist environment. The government is involved in the mortgage business and looks to profit in a sector they should... Okay, let's move on. Let's move on. I smell conspiracy theory there. When you talk about financial sophistication in place now, for example, swaps, there's always one party at the end of the contract having to pay floating. Okay, so I have done that. That was the dealer and how they hedge out. I feel this market is just crazy. Well, you know, you're not alone. I every day look at this market and think, come on. I mean, every indicator says we're overvalued, overextended. You're more than 2 standard deviations above the 200-day moving average, unsustainable at an index level, really. And the market goes up on good news. The market goes up on no news. The market goes up on bad news. It is uncorrelated with the economy right now. And if you observed an individual whose behavior was uncorrelated with reality, you would call them insane. And this is what we have in the market right now, is I think a little bit of insanity. But you have to think about it from a long-only manager's perspective. So here's a long-only manager, large cap, and they're benchmarked to the S&P. They have no choice. They must be fully invested because this is their benchmark. Any cash holding is a negative for this manager because it is an active position. And that means they're underweight the index at that point, and that they better be right. So they got to beat the index. They have no choice. So the top 7 stocks are 27% of the index. They have no choice. They must hold them. So the large cap manager could say, these are ridiculously overvalued. There's no way that earnings can live up to these valuations. It'll take 4 or 5 years for that to happen. The manager has to say, I don't care. It doesn't affect me. It's not my money. It's my investors' money, and they expect me to beat the index. I have no choice but to hold it. So they have no choice but to buy. No choice. And as the market is going up, more people are saying, hey, I want to get in. They put their money into a fund. Money comes into the fund. These managers have to buy those 7 stocks. And as the market goes up, more people come in because of FOMO, and this manager has no choice. He has to buy those stocks. So even though these people coming in are not buying these 7 stocks, they're buying this fund. This fund is benchmarked to the S&P. You got to buy that. You benchmark to the NASDAQ, you got to buy that. They're in so many different indexes that no matter what index you're buying, somewhere along the way, fund managers have to buy those 7 stocks. And really, that's what's causing it, is money flows combined with a long-only bias that's benchmarked. Now, if you had a market with no passive investing and it was all active investing, I think you'd have a lot of managers saying, I'm not buying that overvalued crap. But when you have passive investing, there's no such thing as overvalued. It's just a matter of, I have to be overweight those stocks that will outperform the benchmark. And the benchmark is the S&P. You got to be overweight the 7. You got to be, until it breaks. But who's going to break first? And who's going to risk their job, right? So yeah, the market's crazy. If I had all my portfolio in SPY, with covered calls at 400 early this year, and I got the shares taken away from me. Then I just sold puts in different underlyings with target data 0.1%. Well, would you say it's a mistake? Look, think about it in terms of, let's just do an example with Warren Buffett. No one will argue that he has not beaten the market in almost every year. He has been absolutely successful. But in 1999, he did not participate in .com at all. Would you say that that was right? In 1999, it was not right. But when you look at his performance over time, he was right in 1999 to avoid it, because you don't know when a bubble's going to burst. AI right now is a bubble forming. It is a bubble forming, period. There's nothing else you can say about that. Don't tell me that it's rational. Oh, I know all the arguments about why it's rational, but it is a bubble forming. The best way, and the thing is, you don't know when the bubble is going to break. Is it the case today versus 1999 that the speed of information is so much faster, that everything happens so much faster that it won't take 14 months to burst a bubble? It might take 3 months before everyone says, well, that's enough of that. Could it be that that is the case today, that everything does happen faster? I don't know. Here's what happened in 1999. Is you had VC money that was running into .com. And you had the public markets that were going up based on .com, and VCs rushed their IPOs to market. You had to rush the IPO, which kept pushing the market higher. You had to rush that thing to market. Today you have VCs investing in AI, and the market is going up on AI. What we haven't seen yet is the rush to IPO all of these things for the market to keep going up. We haven't seen that yet. So if you ask me, does this have more to go? Yeah, because we haven't seen this yet. And these VC companies are not stupid. They're going to recognize that the market will take it if it's an AI story, whether it's profitable or not. Much like in 1999, the market took .coms that have absolutely no chance of making revenues. It's because the market wanted to buy anything that was .com. Anything, please, anything that was .com they wanted to buy. Right now, money is investing in nothing but AI. VC money is running into AI at valuations that are ridiculous. We have not seen the IPO surge yet. Look for about the fourth quarter of this year for just IPO after IPO after IPO. NASDAQ 22,000 by the end of the year would not surprise me. Think of something absolutely ridiculous. Absolutely ridiculous. So, but then it's going to break. And in 2 years, if you weren't in that market and you didn't suffer any of the loss from all of those companies, in 2 years, it was the right thing to do. But by the fourth quarter, whatever you're doing, if you're not doing this, it is not the right thing to do. So you can be right in your career, or you can be right in time. Right in time is brutally hard to do. So, you can chase performance and you can try to outperform in every time period. That is brutally hard to do. So when you say, would you say it's a mistake? Are you making money? Then it's not a mistake. Would you have made more just buying the market? Well, you can't look and say, this quarter, I should have just bought the market. Next quarter, I should have just done my own thing, because that's just timing a market in a different way. Pick something that gives you value, that gives you intrinsic value, that doesn't ruin your life, and that you enjoy doing, and do that. Just do that. Tesla is a company which I can never understand. 3 years back, Tesla fan shared his opinion about autonomous driving, and I was wondering, with the amount of Tesla cars currently on the road, how did they get the data? Well, all the cars on the road, that's how they get the data. Wouldn't Toyota, for example, be in a better position? Not if their vehicles are not set up to capture the data, which they are most likely not set up to capture the data. So now, with all, you have to ask yourself, how much data is enough to be able to get something done? How much data is enough? And do you not have enough data at this point in time? There are some things that may be impossible at a micro level that are only possible at a macro level. That's called an emergent property of a system. So if we think about autonomous driving, and you have the micro level and you try to embed autonomous driving into the micro level, that may be very, very difficult to do. But if, let's just take that arrow away there, and let's just assume you have a whole bunch of these vehicles on the road now with sensors everywhere. And this one has sensors everywhere, and they're all communicating to each other. They know the exact distance they are away from each other. They know when this one is slowing down, all these other vehicles know that right away. And here is the street that they're on. Here are the street lights that all have sensors in them as well that can tell you where everyone is. And here's people walking on the road with their iPhone that is in pedestrian mode. So now this car can go 57 pedestrians. This street lamp says blah 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 57, 58 pedestrians. This has 57. Okay, there's a discrepancy. Where is it? And they can communicate with each other and figure out where this person is hidden, and then transfer this information. This car, everything at the macro level. You have autonomous driving without any one car itself having to have the ability to have it. But if you take all that away and you try to get it at the micro level itself, it is near impossible to get done, because there'll always be another piece of data that you need. There'll always be a judgment call that has to be made, and all you need is one death. One death. And I guarantee you there'll be a lineup of lawyers ready to take that lawsuit, because it's suddenly it's big tech, it's big auto I'm suing, and that will happen. The future of autonomous driving is when every element of the road is involved in it, and then you don't have to have autonomous driving embedded in the micro because it happens at the macro. So I firmly believe that this will be the future, but autonomous driving will not be a function of the vehicle. It will be an emergent property at the level of the macro, and only at the level of the macro, but not at the level of the vehicle, if you get what I'm saying there. Okay. What is your outlook on oil, and how do you go about assessing oil prices and energy stocks? Outlook on oil is that you have almost no capex in expanding production at this point in time. So to talk about junior oil mining companies that are starting up here and they'll be bought out by bigger ones and money is flowing into that, that's just not really a thing like it was in 2006, 2007. The majors aren't expanding their oil fields because they know it. The writing is on the wall. The writing is on the wall. Governments around the world want to slit their throats and see them go away. So they're going to manage supply very tightly, and they're going to sit on their asset, which is their proven reserves, and they're going to maximize the value of those proven reserves for as long as they possibly can. They are not going to, I think, flood the market with oil at this point and try to get as much as they can. I think they will bleed it out slowly and keep a very tight market. And the transition is not 10 years away. Think about 30 years before it's all done. So there's still a lot that they can get done, but without new supply coming on and existing supply having to be squeezed through a smaller and smaller hose, because they will reduce supply, you'll have elevated prices for quite some time. And at some point, prices will exceed 100, then 120, and it'll become normalized at 150, 180, and no one will do much about it because it'll be a smaller and smaller part of the population that is reliant upon oil until no one is, right? Is the Applied series for lifetime access just a year? There is no expiration date on the Applied series. Now, when I say there's no expiration date on it, if you buy the Applied series and you log in 20 years from now, you'll have access to it. Well, if I'm still alive and the world still exists, you'll have access to it. But there may come a point where I say, okay, well, there's your content, we're done. But I'll still continue to produce content that if you want some of the updates, there might be an annual update fee. There might be, I don't know. Or I may introduce new products that have different streams that are not included in the Applied series. But for now, I'm dumping everything into the Applied series because I have no other plans for anything. And it doesn't expire that on a certain date, that's it. you can no longer access what you had. You'll always be able to access what is there. And there's still a lot that has to go in there. I don't anticipate that I'll have any real change in my strategy for this for at least another 2-3 years, and then I'll decide what's next. You talked about some Google Scholar study saying the Fed lag to be around 12 months. Could you post some links? Just Google Scholar, and if you type in monetary policy lags, you will get a whole bunch of papers. Get one paper, and the best way to find more papers is go right to the bibliography, and you will have a list of a whole bunch of sources that paper used. When someone is fired but they receive severance pay for, say, 6 months, are they still classified as employed? Well, they're not unemployed yet. They would not qualify for unemployment insurance if they got 6 months severance. At least in Canada, that's the rule. And I think they wouldn't qualify until 2 weeks after their severance ran out. So I don't know that they would even be able to qualify for even claiming unemployment. And if you don't file an unemployment claim, how do we know you're unemployed, right? There might be for counting jobs. If I lay someone out or fire someone and pay them severance, I do have to file a separation form with the government, letting the government know that I have eliminated someone from my payroll, and the reason why I've eliminated them, so that in their jobs numbers they can count that, but that person would not be unemployed at that. Well, let me say, they wouldn't qualify for unemployment, but would they be? I guess they'd count as unemployed because they don't have a job and they're currently looking for a job. So if they say they're currently looking for a job, they'd be unemployed, but they would not be able to collect unemployment insurance. Yeah, I guess they would be counted as unemployed, just not insurably unemployed at that point. GM also got 2 podiums in Le Mans. Corvette won. That's just going to make Corvette harder to get. Damn it. Didn't want to hear that. Crazy rally in stocks. Where do you see the opportunities in the fixed income space? That's a tough one. I don't know where I see it in the fixed income space. I think like anybody else, I think duration is where I'd want to be because it's got a high enough yield, and if rates are going to go down, duration is going to pay off. If you don't think that duration is going to pay off, money market over 5.5% on money market. So that's kind of a nice place to be. Although it is interest, it's taxed at the highest rate. That if you got a bank dividend or a preferred share that was paying 5.5% on an after-tax basis, you're better off. So I still think duration is a good place to be. Recently, I saw a few asset managers excited with small caps. Yeah. I'm excited about small caps because I cannot justify buying these other stocks at these high valuations. So if you see NASDAQ stocks and the 7 big stocks in the S&P at these ridiculous valuations, having run so far, and you need to get in, you'll buy something else. You'll buy whatever else you can. And since small caps haven't participated in the rally until a few days ago, well, okay, I'm excited about small cap stocks because they haven't participated. That is somebody buying what they can, not and somebody buying what they need to buy, as opposed to being fully committed to it, saying I'm in. They're saying I got to get in, but I cannot get in on these stocks. I'm sorry, I can't bring myself to buy at these prices because I know I'm going to regret it. But these stocks over here haven't participated, so how bad could the downside be? If there's downside, I'll buy those. And then of course, it's not enough for me to be excited. I must get everybody else excited because that's the point. So now I must proudly proclaim that I'm very excited about small cap stocks because the stock market only works if everybody knows what you're doing. It cannot be a well-kept secret. So if you buy something, you must tell everybody that you bought it and how great it's going to be, and it's going up because you need them to come in and buy to push the price up for you. Much like Cathie Wood did with Tesla shareholders, telling them, hey, it's a $3 trillion stock, and they pile into it, and she sells it at $800 billion. right? So you have to, when a manager is long something, they've got to be a cheerleader. You can't go on Bloomberg and say, well, we bought small caps. I mean, we don't believe this rally. We can't believe these valuations, but we got to do something. So, they've been beaten up and they weren't recovering, so we bought them anyways. I mean, how can you say that? Look, the fundamentals in the economy itself were not helping small caps. So we bought them anyways, and we're very excited about it. I mean, you can't say that. You got to come in with energy, because you need everybody else to come in behind you and push that price up, right? Let's see. Maybe they think there will be no recession, or that the 2022 correction was enough and that we are starting a new cycle. Yeah, well, here is the dilemma I have, and maybe it's because I suffer from the burden of knowledge. Is when you know too much about a particular thing, you can't see past it. And when I think about it from a top-down macro perspective, it is difficult to see how you can have an accelerating economy while interest rates are elevated, if not going higher. Okay, so even if the Fed doesn't move today in 2 hours, they're going to say that they're skipping. Bank of Canada moved, Bank of Australia moved, the European central bank's expected to move this week, Bank of Japan's expected to move later this year. So you have interest rates in general that are going up. You have credit in general that is getting tighter to get. You have a peak employment. If you expect that you're going to have accelerating growth, where's it going to come from if everyone has a job? Where's it going to come from? Who's next to spend the money, right? Usually you are entering a new cycle when unemployment is high, because as unemployment starts coming down, the aggregate income in the economy starts doing this. Well, there's economic growth. There is economic growth faster. You can get earnings growing faster than economic growth can grow. You have interest rates coming down, because interest rates coming down raises the present value of cash flows. You have credit availability that is not tightening, but is starting to expand. These are all conditions. They look bad. Interest rates are dropping because the economy sucks. Unemployment is high. But these are all the conditions under which great growth can happen, because you can grow back into these things. But when you have unemployment at a 50-year low, when you have interest rates that are high and going higher, and credit availability tightening and the money supply dropping, these are not conditions for the acceleration of growth. So, was this enough and we're starting a new cycle? Again, given my economic training, I cannot believe that we're entering a new cycle at this point in time. When you have something that is divorced, when you have pricing activity that is divorced from the economy, you do not say the economy is wrong. You say the pricing is wrong. So right now, the pricing is wrong, not the economy. The pricing is wrong. So no, I don't think we're entering a new cycle. Tesla valuation. Okay, we can skip that because we've talked about Tesla already. Could you talk about put ratio backspread next week? For example, I see with IV so low, one could buy 2 times the 13% out of the money puts and sell 3 times the 19% out of the money puts on SPY for 2023 year end. Oh, I'd have to look at that. Yeah, I'd have to look at that. Yeah, okay. Here is Tesla again. We've already talked about that. I agree with your Tesla predictions. Okay. More of a question for myself to check. Have the expectations of earnings on the top S&P 500 gone down? I don't know. I think some of them have gone up, but they have not gone up at the same pace as the expansion of the multiple has. So at the micro, you can get all sorts of things going on at the micro. When we're judging the affordability of a market, we want to look at it at a macro level. And at a macro level, year-to-date earnings expectations are down like 3.6%, but the PE multiple is up, has expanded 16 point something percent. Those two things are at odds with each other, right? So that doesn't seem logical to me. Please start sharing your episodes on various podcast platforms like Spotify. Yeah, so I haven't really leaned into this very much. I do this on YouTube because, well, this is what I do, but it's not really what I do. I do this because, it's kind of fun, it's neat to do, but it's not the thing I do. So to start saying, let's turn the weekly outlooks into a business would be, it's like I took advertising off the channel now altogether. So, I'm not in this because it's a business model. So to start going all over the place, that turns this into a business, which requires staff, which requires a funding model. So if you do that, you have to think about, well, how do I monetize all that to pay for the production to get all that done? And somebody somewhere has to pay for it. So either I get advertisers to pay for it or I got to get you to pay for it. But none of that stuff happens free, especially when you got to hire people and use other people's resources. That all has a cost. Right now, me doing this on YouTube the way I do doesn't cost anybody anything. And that is the advantage. The disadvantage is, it's in one spot and it's limited. But if I try to overcome those disadvantages, then the cost of getting it done actually exists and somebody somewhere has to pay for it, right? Where did you get the S&P 500 earnings growth rate, PE growth rate data? Well, the PE growth rate, you could just calculate yourself. I mean, you can look at December 31st SPX and you can see what the price was. You can look on June 8th or 7th and you can see what the price was. If you look at the description box under the market outlook, you'll see link to spreadsheet. And on the spreadsheet, it has the forecasts, and it has the December 31st forecast, and then I calculate a multiple. Then it has the forecast today, and I calculate a multiple. And so I can figure out what the percentage change here was, and I can figure out what the percentage change here was in there. And this is on the spreadsheet. This is just looking in the market. This is just division. I think we're almost done here. If I sell a put and have cash in my account to cover the max loss, do I pay margin interest? No, you do not. You should receive interest on that. It always shows I have positive margin, but I'm not sure if I'm being charged. No, you are not being charged interest. Margin, think about this. Margin starts with the letter M. Margin is me. It's what me has to come up with. So if I sell a put and it says you need $12,000 in margin, that means me must come up with $12,000. Margin is me. And I have $12,000 in my account. There I go. I haven't borrowed anything. You cannot borrow to meet your margin because your margin is what you need. Margin is me. Think about it that way. Margin is what you must have. Can you talk a bit about undervalued picks you are finding? These are mostly the miners. And lately, last couple of weeks, I've been looking for uncorrelated trades to the market as opposed to just the miners. But I like the miners. I like copper. I like the certain energy plays. I still think Oxy is a great little stock to sell puts on, and I do. And the home builders, U.S. home builders, although they are getting to a point where it's getting harder and harder to keep buying them as they keep going up in price. At this point, the home builders should say their CEOs are AI. I think their stock price would at least double. Well, Lennar, I think, is reporting earnings tonight. I think they're going to knock it out of the park again. But I'd be interested to know whether or not they're even going to say the letters AI in their call, like they're using AI for something. And if they say it, maybe that is the jump the shark moment. You know, when your cab driver starts giving you stock advice, it's time to get out of the market. If a company that has no reason to use AI starts saying we're using AI, maybe you're at peak AI. Maybe you're at peak euphoria and it's over. Maybe that's what's needed to burst the bubble early. Let's see. Okay. Frustrates me. Some people like Kaplan want to hit on the belt by saying their website not a CFA charter holder. Yeah, they want to say what I'm not, but they don't want to say what I am. I'm a PhD holder that is active in the market, whereas all of their instructors are not. If you look at their instructors and their resumes, anything they did was 20 years ago, and are unconnected from the real world and unconnected from the market. I mean, it's easy to do that kind of thing, right? I'm not where I am because of my deficiencies. I am where I am because of my advantages, and people have found my advantages to be their advantages as well. But I will say this, I get along with the people at Kaplan, I really do. That for them to put something like that up seems rather kind of, shitty to me, but hey, what are you going to do? I will say this, if your competition is not trying to put you down, it's because they don't see you as a threat. So because they're saying this, they absolutely see me as a threat. And to that I say, well, thank you for noticing. You're right, I am a threat. But they are in essence complimenting me by recognizing that I am so significant to their thinking that they have to do something, and this is their best course of action, is to do this. Any legal barriers preventing you from getting it? No, there are none. I just got to write 3 tests. Does anybody out there think I can't pass 3 tests on content that is not proprietary to CFA? I have a PhD, so I've been trained very deeply in quantitative analysis, far deeper than what level 1 and level 2 quant are. The economic sections, there's nothing in CFAI that's proprietary to CFAI. That's just aggregated from textbooks. Well, let me tell you, I've seen enough economics textbooks in my life. I can reiterate almost all of them to you. The only thing that CFAI has any proprietary advantage on is the code and standards and GIPS. I mean, that's it. Everything else comes from the pages of other textbooks that I have seen ad nauseum. It would be me passing 3 tests. But does anybody think I can't pass 3 tests? You let me know. Confused about the central bank funds market. I think there was a question at the very end because I saw this one. Maybe not central bank. Is it the bank that does all the lending and borrowing at the Fed funds rate? No. No. Lending out funds of banks. No. Banks will lend to each other. That's called the wholesale market. So if I have excess reserves, I can lend them to another bank that doesn't have excess reserves in the wholesale market, whether it be overnight or for a term. Let's see it, and borrowing from other banks. Or is it banks who lend and borrow among themselves for as much as they possibly can? The Fed is called the lender of last resort. In other words, you can't get it done anywhere else. Then you can go to the Fed, but that usually invites scrutiny, which banks don't really want. If the second option is correct one, do depositors get a piece of that interest earned? Why would they? That's not the deal. The deal is, I'm a bank, you come to me and you say, I'm going to deposit my money here, and I say, great, I'll give you 0.5% interest, and you say, okay, and you deposit your interest. What I do in my own business is my own business. I don't got to share anything with you. It's like saying, if a company can increase its margins, does it then share that with its customers? Well, if the price you pay is the price you pay. If it increases its margins, it does not then send you a rebate check. No, that's the deal it makes with you. You pay this, and then if I can increase my margins and decrease my cost, I can do that. But no, it does not share that with you. There is no sharing in that sense. It seems like banks are making money off the backs. Well, that's what profit is. Any company that's going to stay in business has to make profits. It makes those profits off the backs of its customers. We can't have a system where everybody does everything at cost. Who would risk any capital to participate in a system where everything is done at cost? I'll get back exactly what it costs me to deliver it to you. There must be profit. And all profit is made off of somebody else. So it is off the backs of whatever, but that was the deal. If the economy is more interest rate sensitive, why doesn't the Fed reduce its balance sheet more than 90 billion? I agree. I think it could. I think it should have. Can you tell us more why you think Tesla might actually fail? I think the big thing to watch going forward, it's not so much their technology. I wouldn't say they'll fail based on that. You got to watch their cash flow, and I think that'll be a more important thing to watch going forward is their cash flow. I agree with some points you're making about Tesla. Okay, I do think you're misinterpreting some key claims on your bearish thesis. Probably. Would you read a detailed letter if I wrote it addressing your claims and send you on LinkedIn? Send it away. Send it away. I'm more than happy to engage with other intellectual people who want to talk about something. Just because you have a different opinion than me doesn't mean we can't talk. There's probably stuff you can learn from me and stuff I can learn from you. That's the point about collaboration, is you bring your points of view, I bring my points, and we move somewhat closer together, right? And maybe I temper your bullish view and you temper my bearish view, and I get to see that to me is an intellectual pursuit worth undertaking. But when, again, as I said earlier in this video, when somebody just starts by calling you names, you just shut down. It's like, what's the point, right? I mean, okay, there's more about Tesla there. Kathy Wood. It's obvious NVIDIA is overvalued. Why are analysts giving an average price targets of 455? Bank of America, 500. Well, that's the thing. You know what you've seen in the last little while, and I've noticed it in my feed, in my news feed from Interactive Brokers, is all the price target upgrades that are happening, and the different views from the different analysts on the economy as a whole, and people upgrading their views on what's going on. And I wonder, are people upgrading their views and raising their price targets because the economy is getting better? Or are they doing it just because the stock market's going up? See what I mean? A rising stock market without the fundamentals can still cause this to happen. And I think that might be what's going on. Market seems to make no sense. Seems like it should be trading at 33, not 43. Seems like a huge sell-off is in order. I don't know about a huge sell-off, but it is odd to travel this far away on an index level from the 200-day moving average without having some kind of correction, not because the market should go down, but only at some point do a group of fund managers say, you know what? It's been a pretty good run. We should take some money off the table. And as they start doing that, that usually starts the weaker hands to take their money off the table as well. And typically you can get a 3 to 5% pullback, which is healthy if you expect it to run another leg. But the more and more it goes in one direction, the more and more unhealthy the market gets, the bigger and harder the correction then becomes when it does happen. It is healthy to have it so that if this truly is something, it would seem to make sense that at some point somebody somewhere would say, shouldn't we take some money off the table? And by the way, Kathy Wood took money off the table with Tesla. So, now that I look at her in the light of, well, she wasn't really believing what she was saying, she was just playing the market, she took money off the table, I think she's kind of brilliant now. Maybe I'll start listening to her and following her and saying, hey, Kathy, why don't we talk? Let's see, I drive a Tesla, okay. I had to wait 90 minutes in an Dynamo supercharging station. Yeah, there is. California has a problem with that as well. Apparently, that pulling up to one of these Tesla stations, you still have to wait. It's really bad in the UK, apparently. If anyone from the UK is listening and has a Tesla. Let's see. Did you go to the UFC live in Vancouver on Saturday? Canada's big. Vancouver is 3,000 miles away from me, so no, I didn't go. Do you read the comments? No, never. Sorry about that, but I just don't have time to read all the comments. I don't read them. That's ironic, isn't it? Okay. That's it. We have a Fed decision in an hour and 40 minutes. And remember, it's not the decision, it's the press conference where the real action happens. Okay,